Trading is a game of deceptions and traps, and you must learn to play accordingly. I learned this the hard way with my own money. When you enter the trading game, one of the first concepts you learn about is the moving averages, and for a good reason. Moving averages represent one of the most visually effective tools for scanning markets. Their simple concept of filtering out noise and to identify trend biases appears compelling. Traders gravitate towards moving averages because of their clean visual communication of uptrends and downtrends. When prices cross above or below these lines, we get excited. It subconsciously triggers decisions, seeking confirmation of emerging directions. In fact, one of the fundamental rules of technical analysis is the moving average breakout, and I can show you a lot of textbook examples showing this principle in action. A moving average acting as dynamic support turns to resistance once broken, and the previous line acting as resistance morphed into perfect support on retest. It's the kind of signal every technical trader lives for. We all took this kind of trade in the past. But as obvious as some of those patterns look in hindsight, there is an important thing most people miss. Only a small percentage, maybe 15 to 20% of moving average breakouts actually play out as cleanly as the textbook examples. It all comes down to understanding how moving averages work. A moving average shows the average price of the market over a period of time, like the last 50 candles. Traders pay close attention to when the prices crosses above or below the moving average line. That's because it signals whether the trend is turning from up to down or vice versa. But here's the thing, smart traders know other traders are watching those moving averages too. So sometimes they'll push the price briefly over or under the moving average, even if the main trend is still going the other way. Their goal is to trick people into thinking the trend has changed, so those traders jump in, and then the big traders reverse the price back where it came from, trapping those followers with big losses. The reality is that the vast majority of moving average breakouts end up being fake outs or false breaks that fool traders. Just because the moving average is broken, the new level doesn't guarantee anything about what comes next. More often than not, price action just wicks through this zone, then continues the initial move. Some call these false breakouts, others see them as liquidity runs. And while they cause trouble for traders who get trapped, if you spot them coming, you have a chance to profit. Those false breakouts can really mess with your head. As I was losing most of my trades using this signal, I started to understand why it happened. Common moving averages, like the 20, 50, or 200, are like battle zones between buyers and sellers, pushing price both ways. So it makes sense the price action wavers in and out sometimes, before settling again. What really sunk in for me is that chasing moving average breakouts after a strong trend is likely to lose money overall, especially as a beginner. Those massive explosive moves that seem so easy to catch are actually pretty rare, and even if the break is real, actually hanging on through volatility and exiting at the right time takes a lot of experience. I had a major breakthrough when I finally understood the concept of liquidity. Liquidity is all the orders that are stacked up in the market, waiting to be executed. Liquidity usually builds up on the both sides of the moving average, especially when there's a breakout. This is because there's a lot of traders using similar entries and exits. Buyers who think the market's going up tend to buy when price moves above a moving average, placing their stop losses below it. Sellers who think price is going down put their stop losses above the moving average when the price moves below it. And this is exactly why a lot of times moving average breakouts don't have real buying or selling conviction behind them. And as soon as stops get taken out, above or below, prices whip right back the other way. That ends up leaving a bunch of trapped traders who help fuel the reversal with their stop losses. The momentum they provided can really move the market away from the moving average in the opposite direction. During strong trends, it's smarter to wait for these failed breakouts to happen before entering. The risk is way lower versus chasing the initial move, and the potential reward is way higher if price bounces hard after squeezing those stop runs. Let me explain the strategy I use. The first thing I watch is for a strong trend. To me, that means the price has been steadily rising or falling for at least a couple of days without reversing more than a few percent. You want to see higher highs, higher lows, multiple breaks of structure, and no major change of character. During these trends, institutional traders have the market under their control and can manipulate prices more easily. Once a strong trend is in place, I'll monitor the moving averages. Usually, a 50 period is all I need, but you can select any period you want. Just make sure you use a common one, like the 20, 100, or 200. I'm looking to see if the price crosses above or below that average line, but stays there for only a very short time, only for a few candles. That's a red flag. It might be a false breakout. The next thing I check is the volume. On a real trend change, you'd expect volume to spike as more orders pile in. But with a false breakout, volume is often lower than normal. That tells me not many people took the bait of the fake signal. If I see a liquidity run, that's the strongest signal I can get. Armed with those signs, I'll enter a position against the false breakout. So if it crosses above the moving average during a downtrend, I'll short the market, and vice versa. Let me give you an example to help explain it better. In this chart, oil prices had been steadily increasing on high demand. The 50-period moving average was rising strongly in line with the uptrend. Multiple breaks of structure during this trend. And here, price dipped under the 50-period average for just a couple of candles before rebounding right back above. Volume was surprisingly low for such a market-moving event. And look at this liquidity run below this level. I call it a double trap. This move below the moving average trapped price action traders waiting for a break below this level, and at the same time trapped moving average traders. To me, it seemed like a false breakout designed to attract short sellers before resuming the rally. And sure enough, prices had reversed all the way back up, causing big losses for anyone who shorted the breakdown. The smart play here was going long against the fake signal in line with the previous trend. On the flip side, there's a similar situation. Price has been tanking for days. Multiple breaks of structure to the downside, lower lows and lower highs, and the move above the 50-period line. Again, it was barely above for a few candles on lighter than usual volume. Observe the liquidity run, trapping another group of buyers to the upside. And of course, price reversed direction and broke below the moving average once again, accelerating its fall further. The play here was going short against the fake signal once price moved below the 50 moving average. It doesn't matter the market you trade. That's the beauty of this strategy. Gold prices had been making higher highs and higher lows in an upward trend, with the 50-period moving average reflecting the positive momentum. Then gold took a quick nosedive below the moving average. We even had a liquidity run during this period. Despite the initial panic in the market, the volume during this drop was notably lower than expected for a significant trend change. The correct trade was a long one once price moved above the 50 moving average. After a prolonged downtrend, a false breakout presented an opportunity. The price briefly rose above the 50-period moving average, moved past this level, that being a liquidity run, causing a stir among traders. We had low volume during this move, so long positions were off the table. As price reversed direction and dipped back below the moving average, that was the time to enter a sell position, in line with the previous trend. In this recent trend, where the market had been climbing steadily, the 50-period moving average was on my radar, as price briefly dipped below the moving average and also registered a liquidity run. This move caught the attention of many traders, but the volume during this dip was surprisingly low, a textbook false breakout, trapping sellers on the short side. And true enough, within the next candles, the price bounced back above the moving average. This was the ideal time to enter a long trade, capitalizing on the trapped traders below the moving average. Here, the market had been on a positive trajectory for days, aligning well with the 50-period moving average. Then, out of the blue, the stock dipped below the moving average, setting off the alarm bells for many traders. Observe also this liquidity run and the low volume during this dip. All our conditions were met. Strong trend, a move below the moving average, a liquidity run, and low volume. And fair enough, the stock swiftly climbed back above the moving average, and that was the perfect moment to initiate a long trade. By recognizing the patterns of smart money manipulating prices with false breakouts, you take the emotions out of the trade. You're not getting swept up by the crowd, being baited by a fake signal. Instead, you profit from the liquidity run that inevitably follows. And some key aspects to remember. Only trade these setups during strong trends, when major market players have more control. Watch for breakouts that last only a short time, like a few candles. Check the volume. It should be unusually light. And take a tight stop, in case it turns into a real breakout. It's an easy strategy, but it requires staying cool-headed and trusting your analysis of the market structure. Don't get fooled by the hype, and focus on the big picture trend. Pay attention to the signs of possible manipulation by the big money. When you spot a false breakout, get in the position to profit as the price retraces where it came from. By following trends and outsmarting the tricks of the institutional traders, you will too start seeing bigger gains. And just keep practicing spotting the pattern. Study all charts to compare tells of real versus fake signals above or below the moving averages. And most important, when you find another liquidity run above or below a previous key level, you have found the strongest signal. With experience, you'll get better and better at making the difference between genuine trend changes and traps set by the smart money. And this strategy won't work perfectly each time, but it has served me well over the past months. There will always be ups and downs, of course, but as long as you focus on the big picture and remember your edge, you'll come out ahead more often than not. That's how I've succeeded trading moving average breakouts, by recognizing these traps and turning them to my advantage instead of becoming victim to them. Now it's your turn.